Welcome to Brian's ASPE review for CPA Core and CFE. Today, we are going to cover inventories under ASPE 3031. Inventory or stock refers to the goods and materials that a business holds. When inventory is sold, the amount should be recognized. What is inventory? Inventory refers to all the items, goods, merchandise, and materials held by a business for selling in the market to earn a profit. Examples would be any items, usually are physical assets, companies that can measure and count. To be defined as an inventory item, it is required to meet any of the three inventory criteria. Number one, it must be held for sale in the ordinary course of business. This means that businesses must have items available for sale in the normal business operation. Number two, it must be in the process of production for such sale. This means that the inventory items are being produced for the purpose of making sale transaction. And lastly, number three, it must be in the form of materials to be consumed in the production process of services. This means that inventory as materials to be used in the production for developing final product for resale. For recognition of inventory, cost is the amount of cost to acquire the inventory. Inventories are measured at the lower of cost and net realizable value. Net realizable value is the total amount of money an asset might generate upon its sale, less a reasonable estimate of the costs associated with that sale. When inventories are sold, the amount is recognized as revenue and related cash or accounts receivable. Inventory write-down are recognized as expense. It is recognized in the period that it occurs. For example, there are many items are being sold at a grocery store shelves. For one of the dairy products have a shelf life of 10 days. The grocery store purchased the milk for $8 from the milk factory. However, after 10 days, the milk is rotten and cannot be sold. The value of the milk is now $2. As the value of the milk went down, we must take the lower of cost and net realizable value. NRV of $2 is lower than its cost of $8. The difference of $6 should be written down to NRV. An electronics store purchased 200 smartphones to sell to customers. The electronics store paid $700 per smartphone. The smartphones were delivered by seller for $250. For the next 2 years, only 100 smartphones were sold. However, due to smartphone obsolescence, the value of each smartphone decreased to $300. For definition of inventory, smartphones meet the definition of inventory as it is held for sale in the ordinary course of business. Therefore, smartphone is an inventory item. We must measure the smartphone as lower of cost and NRV due to obsolescence. The store paid $700 per smartphone for 200 smartphones, so 700 times 200 is 140,000. There is a delivery fee for the smartphones of $250, so this fee is added to purchase cost of $140,000, so it's $140,250. The total cost of inventory is $140,250. So to record journal entry, debit inventory by $140,250, credit cash $140,250. And when smartphones are sold, debit cash for $70,000 and credit revenue for $70,000. Now we must determine the net realizable value. There are 100 smartphones sold and 100 smartphones are remaining. The smartphones was originally purchased for $700 and 100 were remaining, so it's $70,000. The smartphone is $300 and 100 were remaining. We times 300 by 100, which is $30,000. Because of the value of 100 smartphones went down from $70,000 to $30,000, the difference must be written down. $40,000 is the impairment amount, and this is to be expensed. So we debit write-down expense account for $40,000 and credit inventory for $40,000 to reduce the inventory amount. Other things to note is when the amount of write-down is reversed, but the reversal can exceed the amount of original write-down. Today, we covered inventory section of ASPE 3031. We learned about inventories are purchased and it should be recognized as LCNRV. I hope this lesson was helpful, and feel free to ask me if you have any questions. Have a great day!